So tell us about the reputation of hard money, if it's deserved or not deserved, and even maybe why are they called hard money loans?
Well, and I think hard money loans derive from the fact that the lenders make loans against hard assets, real property, to be particular, as opposed to, again, some of the other, externalities that a situation or borrower might bring to the table in terms of credit or FICOs or, industry characteristics or just stuff that doesn't derive strictly from sticks and brick and land and building improvements. That's generally the thing about hard money loans. They're not working capital loans, right? That's kind of a personal property right. Somebody owes you some money, but hard money lenders wouldn't make loans against basically working capital. They prefer borrowers that have lots of working capital, right, or loans payable, as opposed to, that only have liabilities. It's an asset, but it's not a real asset like real property. Mm-hmm. So I think that's the genesis of the term hard money lenders. It's that, or again, it's that, their terms are hard. They're not the most preferred in terms of, again, okay, I'll give you a zero interest, like student loan. Collateralized by nothing, right? I mean, it's a personal obligation. It's not secured. It's not secured by, any particular thing. Hard money lenders, again, are sort of saying we need an asset to secure, to say, hey, this is going to guarantee that we get repaid. Like most lenders, they want to get repaid. Some of them are willing to do it on an unsecured basis, but guess what? There's a lot more risk there, so they're going to charge a lot more. Hard money lenders or any secured property lender is able to say, look, I've got some other primary repayment method in addition to the borrower's goodwill and character and, that they're going to try to make this right. And that's enough, so I can charge X. Again, any unsecured lender to me, credit cards, 24%.
Right.
They have no security
right.
except your promise.
That's right.
Promise is great, but obviously a lender prefers, real property that, if necessary, they could own to guarantee that they get repaid.
So, thank you. And can you share with us some different types? All hard money loans are not created equal.
Sure,
right?
For sure. Yeah, there's efficiency even within that sort of substrata about who will finance what and on what terms. Land. Land is kind of risky because for a while it's a liability. You got to keep the weeds off of it and you got to pay taxes on it. So a lot of lenders just say, forget it, we're not doing land at all because it's not an income producing asset. That piece of land, except for, Christmas tree, occasional lot rentals, right, when applicable for a couple of years, or rather for a month or two in a given year, it's not income producing. I mean, you can't do anything with it except build upon it. And most lenders are not in that business. It's clearly worth something. It's the one thing they're not making more of. So there's some value to it, but a lot of lenders say, hey, forget it. We won't do land at all. Or if we do, it's going to be the least efficient of that pricing because all they have at the end of the day is, again, this lot or buildable parcel, but to extract value from it, you got to put something on it. And that too costs more money, which is not the lender's perspective at that point. They want their money back. They don't want to expend more money. Mm-hmm. So again, in the space, compare that to a fully occupied apartment complex. I mean, that thing pays for itself, probably, and then some, meaning it has a monthly, cash flow that is more than sufficient to pay a lender's debt. So any lender on that property is going to be saying, again, compared to a land loan, well, gee, this is a fantastic collateral because he earns, if his promise was worth nothing, the property earns twice as much as the monthly mortgage payment I'm going to advance him, hypothetically twice as much. That's a fantastic property to lend on because, again, the property itself generates twice as much income as is needed to service the mortgage. Mm-hmm. That looks good. Between that and the borrower's promise, we feel like we're pretty comfortable that this loan is a secure loan and we can give it our best and final kind of pricing. Like most lenders would be looking to advance on a property like that, including the banks. And many of those properties might be initially bankable, but for whatever reason, credit or history or I don't know what, location, certainly. Some lenders might say, well, we like it based upon the income, but there's other reasons that we have to either can't do it or we have to tax it in terms of the rate at which we can do it. So yeah, again, even in the hard money space, there's sort of preferences that each lender can have them. And they're, you know, I don't know that there's any science to it. It's more like sometimes their own experience. Some lenders might have done really well with a particular construction loans, for example. Others might say, hey, you know, we learned painful lessons that way, and we don't want to go back there.
Right. So to summarize, you've listed several different types of hard money loans,
Sure.
from land loans
Sure.
to fully occupied,
Yeah.
income producing,
Right.
well debt servicing properties,
Right.
and there's going to be something
Yeah.
both continuing in between those.
Yeah.
You've mentioned construction loans,
Sure.
or even acquisition and development loans, and those are, you mentioned maybe not all lenders are interested in doing that, but that certainly is a type of a hard money loan as well, right?
Yeah, absolutely. And again, as to owner-occupied commercial real estate, that's one in particular segment to me that a lot of lenders fumble with because they don't know what the property would rent for or be usable for or its rental value. So they have trouble dialing in on something like that because there's no market-derived, you know, with an apartment, you know perfectly well what it's going to rent for because it's got tenants at that rate. And you can look at the marketplace and say, you know, are the vacancies really low and this is a really tight market and a really good market? And, you know, basically you're always going to get that monthly rental payment, even if that particular tenant fumbles. There's going to be a replacement tenant at approximately the same rent, maybe even higher rent. Et cetera, et cetera. In owner-occupied real estate, you often don't have that. So a lot of lenders choose to sort of say, hey, because I don't know, I can't price it efficiently. Others, you know, try to dial in on it and say, well, we think the building would rent for X. And because of that, it has an implied rental value anyway of Y. And that number, with expenses removed, et cetera, is sufficient to pay the mortgage along with the borrower's promise. So that loan starts to look good. Again, others might, a la the land scenario, just say, I don't know. And because I don't know how much I can lend on it.
Mm-hmm.